The future, self-directed IRA investing. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. And today's Adam Talks, the self-directed IRA Trust. Is it the future of self-directed IRA investing? So this is a topic that has been getting more and more attention really since January 1, 2024, really because of something called the beneficial ownership interest filing requirements under FinCEN or BOI under the Corporate Transparency Act. And essentially under the CTA, any new business entity, including self-directed IRA LLC, that was established in the United States as an entity in 2024, the 90 days has to file a BOI, a beneficial ownership interest report, letting them know, or FinCEN know, who 25% or more shareholders, which in the case of a self-directed IRA is not an issue because it's an IRA, but more importantly, who has substantial control, responsibility over the LLC, which is the IRA owner. So I was probably the first person back in 2008 or 9 to start working with something called a self-directed IRA Trust. And I actually stopped working it a couple of years later just because I ended up finding out that the LLC was just easier. So the concept between the self-directed IRA Trust, and I'm going to share my screen. If you're watching on YouTube, you're gonna be able to see my screen. If you're listening, I get it, but you could switch to YouTube and check out what I'm about to show. And it's a flow chart of how the self-directed IRA Trust works. But it's really the same idea of an LLC. So you have an IRA, right, that owns, instead of an LLC, it's gonna own a trust. And I'm gonna talk about what a trust is, what a grantor trust is. And the reason I created this back in the day is there were a bunch of clients that said, hey, Adam, I want to have checkbook control, but I don't want to pay the LLC fees, right? California has an $800 franchise fee, Massachusetts, $500, or even states like Florida, it's a couple $100 a year. And I don't want it. Okay, I want checkbook control. I want to have an entity that I could control that could be my vehicle to make investments, but I really don't want to pay a state any fee for that. So that's when I designed this trust structure. And the way it works, simple, right? If you see the flow chart, just assume the trust is an LLC, right? You have an IRA, roll over into IRA Financial, and then instead of investing in an LLC, is going to be the grantor or fund the trust. And then the trust will make the investment into real estate or whatever the investment is. So the trust really serves the purpose as a special purpose vehicle to make the investment. Now, a trust is not an entity established under state entity rules, meaning you don't file Secretary of State to form a trust. A trust is a private agreement, essentially between three parties: a grantor, person created the trust, a beneficiary, who's the recipient of the benefits of the trust, and a trustee, who controls the trust. Those are the only three parties in a trust. Could be all three. Some states don't allow, but generally, those are the three parties, right? I can set up a trust for the benefit of my kids, and I or my spouse can be the trustee. It could be a revocable trust, which you can revoke at any point, terminate, or irrevocable, which is used mostly for estate planning. The idea about an irrevocable trust is you get assets in a trust that you have no control over, and therefore it's out of your estate. So if you pass away and you have a lot of assets above the unified credit for that year, or you die, the assets in that trust that are irrevocable are not included in your estate and therefore not subject to estate tax. But in purposes of a self-directed IRA, we're not worried about life or death. IRAs don't die. The trust is going to be used as a special purpose vehicle to make investments. So what is it going to do? It's going to give you checkbook control. It's going to give you speed. It's going to give you control. What it's not going to do, it's not going to give you limited liability protection, right? And that's why at the end of the day, I really, didn't put a lot of emphasis and effort into marketing self-directed IRA Trust all the way back into 2010, because I just felt the whole concept of limited liability protection was important. And I personally still believe it's worth a couple $100 a year to the Secretary of State to gain that opportunity. Limited liability protection protects all your assets outside of the LLC. It doesn't protect the assets in the LLC, but it protects it outside, all the assets you have outside the LLC from credit or tax. So there's a lot of value in an LLC, plus all 50 states recognize it. The laws are very uniform and easy to understand. The other situation with trust, the issue I had and continue to have to some degree, but I'm working around it, is that every state generally has different trust rules. Okay. So that means not so much from a federal tax standpoint. A grantor trust has to file a federal tax return 1041. There's easy exemptions around it because the whole idea of a grantor trust is the grantor is responsible for the income of the trust. Okay, kind of like the LLC owner. So if the grantor essentially could acknowledge on the return that, hey, I'm going to pick up all the income in my own tax return. But in this case, the grantor is an IRA, right? If the grantor is an IRA, IRAs don't pay tax, federal tax. We know that. So now we have to look at each state. When it comes to LLCs, it's much cleaner because other than a few states that have franchise taxes, like California, Texas has, but there's an exemption under 2.2 million or so. Most states do not tax state income to an IRA. Okay, they follow the federal tax treatment. In the case of trusts, most states also follow the federal treatment, but some states don't. And it's a little bit more unique for certain states. Now, there are popular states for setting up a trust, and that's going to lead me to the next question is to where should you set up the trust? Now, most people are going to set up the trust in the state where they do the investment. If it's real estate, you're generally going to want to set up the trust in the state it's going to own the real estate. If you're not doing real estate, then you probably can set up the trust in any state. Now, certain states do have advantages over others when it comes to filing or setting up a trust. Now, again, you don't set up a trust with the Secretary of State. It's just a piece of paper. It's a trust document that is going to say where the domicile of the trust is. So the most popular states for setting up trusts, and these are the 7 states that don't have any state or franchise taxes. South Dakota, one of my favorite, right? Delaware, Wyoming, Alaska, Nevada, New Hampshire, and Tennessee. Okay, those are known as the Big Seven, the 7 states that have no tax, no franchise fee on state income. Now, most other states will not tax, from a state tax standpoint, any trust income allocated to an IRA, even if there is a state tax, because they follow the federal tax exemption of IRAs. There's several states where it's unclear, but states that don't have any state tax, like Florida, will not tax trust income to an IRA. Texas, even though they have a franchise fee under the exemption of 2.2 million, you're not going to pay any state tax on any trust income allocated to the IRA. But certain states, it's a little uncertain, like Missouri, Connecticut. There's really nothing on the books that's going to dictate and illustrate if they're going to tax IRAs that receive trust income. But most of the other states, even if they do have a state tax, will follow the federal tax exemption on IRAs, like Massachusetts. Most of them, 9 out of 50 states, I think 45 to 46, has clear language in their books that they're going to follow the federal tax treatment of states. So why do I say this is the future of everything? Well, the BOI, if you want to have checkbook control and you don't want to file a beneficial ownership interest form with FinCEN, even though it's not the end of the world, we do it for you. It's not a form that the IRS is going to look at to audit. It's really done by Treasury, Homeland Security to go after bad guys that are terrorists or using the U.S. financial system to do no good, like money laundering, things like that, illegal activity. But I get it. Some clients don't want to deal with BOI and FinCEN. The less filing, the better. And then the trust structure will be a really good solution. You will not get limited liability protection. Okay, that's something to keep in mind. If you are engaging in a transaction that does have some risk, real estate, you're not going to have LLC limited liability protection, but the trust will give you the same checkbook control freedom, the ability as trustee to control it. We'll set it all up for you. Depending on the state where you're going to be doing the investment, you shouldn't have any state income tax. And if you're not doing real estate, let's say you're doing a private placement, a private investment in a business, a hedge fund, venture capital fund, then you can do the trust in South Dakota. You can use our address. The IRA technically is domiciled in South Dakota. No state tax, no franchise tax, super clean. And then you could use the trust as the investment vehicle to make the investment. No limited liability protection, but you do get checkbook control. You can have the bank account. You're the trustee. Really good vehicle in those cases. So I spent the last, a couple months working on the solution, kind of dusted it off the bookshelf because I've always been like, listen, I created this trust solution you can say I'm the father of the trust solution, but I always was a bigger fan of the LLC just because I do feel that having limited liability protection is an advantage, and I think it is worth the cost. Now, in California, it's an $800 franchise fee. And California trusts are difficult too. So the one thing to keep in mind, as I said, every state has different trust rules. So if you are a resident of California, even if you set up a South Dakota trust, California is super aggressive, and they will try to tax the income on that trust because they're going to argue the trustee is a resident of California. So investment decisions for that trust are happening in the state of California, therefore pay us the tax. That's pretty unique. Again, California is one of the few states that are super aggressive on that end. Otherwise, it's not a major state tax issue, especially if you're in a state like the Big Seven, and you're not owning real estate in any of those states, you're doing passive investments, you're not going to have any state tax issues, really, unless you're a resident of California. So I do believe the Self-Directed IRA Trust could become the future of self-directed IRA investing. We're one of the few companies, again, because I designed this, that actually work in it and can design it and structure it, set it all up with the trust documentation. You're not going to have to file anything with the LLC. You're not going to have any LLC annual filings with the state, but you will not get limited liability protection. If that's not an issue, then you'll still get the checkbook control. It will still give you freedom, flexibility, privacy, more anonymity than an LLC, because you can't find out who owns this trust because it's a private document. The LLC, you can go to most Secretary of States and find out who the registered agent, who the owner is. In the case of a trust, you're not going to. There's no repository of information. They're private documents. So from a privacy standpoint, super, super beneficial. But again, no limited liability protection. Will help you with trust returns and dissecting any potential state tax ramifications, because again, each state has different requirements for whether the trust is a domicile in that state and whether the trust has nexus to that state. And we're one of the few, if not the only, self-directed IRA company in the country that can help you navigate those rules. So that's today's podcast. I hope you guys enjoyed it. It's really just an introduction to the future of self-directed investing. Maybe I should have been pushing and marketing this product longer. But again, I've always been a big fan of the IRA LLC. I've written 2 books on it. But I think going forward in 2024, the Self-Directed IRA Trust, may prove to be a very, very important, valuable solution because of BOI and FinCEN, and because some folks just, don't want to share information if they don't have to with the government. I get it. I totally get it. I get you. I respect that. So that's why I'm going to start working a little bit more with the Self-Directed IRA Trust and starting to educate people about that. Yeah, you could use a trust as an investment vehicle, like an LLC, not have limited liability protection, but still gain checkbook control, privacy, freedom, and still do the investments you need to do, same prohibited transaction rules, and we will still handle everything for you. So that's it. I hope you guys enjoyed today's podcast. Please leave a good review, rate it. The more reviews, better ratings I get, higher the podcast gets positioned on Apple or Spotify. More people get to watch it or listen to it, and that's just the name of the game. We all can benefit and learn from each other, and that's why I do this stuff, so people can be smarter, wiser, and hopefully richer self-directed retirement investors. So that's it. Appreciate you hanging out with me today, and I hope I'll see everyone again next week. Have a great one. Thank you.